Hello friends. Friends, we are going to continue with share capital, right? And in share capital, we are going to do one last topic of share capital. This last topic is employee stock option plan. This is also known as ESOP, right? Employee stock option plan. Now, this is not much an important topic from examination point of view, but yes, you should have the knowledge of ESOP, right? You should know what is an ESOP, how it is dealt with in case of share capital, right? Now say a company has 1000 shares of rupees 10 each, right? The company has 1000 shares whose face value is rupees 10, right? If you go in the market to buy this share, its value in the market is say 250 rupees. Its value in the market, that is market value of share, is market value of share is rupees 250. Face value is 10, market value is 250. That is 240 is the premium at which the share is being sold in the market, right? Now what happens? You are standing on 1/4/2016, right? You tell your employees, company tells its employees that if you continue for 5 years, in our company, then we will provide you these shares whose market value is 250, for rupees 100, right? Okay, write this down. On this date only, company gives an option to its employees. Suppose there are 100 employees. Gives an option to its 100 employees to subscribe to its shares. I'll take the market value less for simpler calculations. Say the market value of the share is 60 rupees. Okay. So the company has 1000 shares of 10 each. The market value of the share is rupees 60. The company gives an option to the employees, 100 employees, to subscribe to its shares of market value rupees 60 at rupees 40, right? Company gives an option. Number one, it is an option. It is not compulsory for the employees to buy the shares, to subscribe for the shares. It is an option given by the company to its employees. How much? 100 employees. What is an option given? They say that after a service of 5 years, if you wish, you can subscribe to the shares whose market value is 60, but we will provide you at 40 rupees. Clear? Company says we will provide you at a value which is less than the market value. Clear? So this is the employee stock option. That is an option being given by the company to the employees to subscribe to its stock. Stock means shares, right? After a certain period of service at a value which is less than the market value. Clear? Clear? Now, this 5 years period, this is known as vesting period. Right? This 5 years period is known as vesting period. Clear? Now for the company, the market value is 60 rupees, but the option is given at option value is 40 rupees. Now what is this 20 rupees? This 20 rupees is loss to the company, or I can say it is a loss or expense for company, right? This is a loss or an expense for the company, right? This is a loss or expense for company. See, here also I will do 100 shares for simpler calculations. Let us take company as only 100 shares, right? Now ESOP says that this loss or expense for the company, this you have recognized on 1/4/2016. There is a vesting period of 5 years after which the option will be exercised. Option can be exercised by the employees, right? So they, whatever loss or expense you are incurring today, this is to be written off equally, not written off, I can say this is to be not written off, this is to be divided equally among vesting period, right? That means he says whatever loss or expense, this 20 rupees which is the loss or expense of the company on 100 shares, right? This loss of the company is to be written off over the vesting period. Clear? Clear, friends? So you can write this down. This much you can write down. Vesting period. Clear? So this is ESOP where the option is given to the employees to subscribe to the shares of the company, right? Now can you tell me, if you have 100 shares and option is given to 100 employees and there is a 20 rupees loss, what is the total amount of loss? Total amount of loss. This total amount of loss will be on 100 shares multiplied by 20 rupees for 100 employees, right? 100 multiplied by 20 multiplied by 100, this comes to 2 lakh rupees. So there is a total loss to the company of 2 lakh rupees. How? 100 shares being subscribed by 100 people. An option is there. 100 shares to 100 people multiplied by 20 rupees loss. Because market value is 60, option value is 40 rupees. So there is a loss of 20 rupees on each share. So loss on 100 shares, 2000 rupees. Now multiplied by 100 employees. Right? So this total loss comes to 2 lakh rupees. Now what is the vesting period? Vesting period is 5 years. Right? So what is the loss to be recorded every year? Every year loss will be 2 lakh divided by vesting period. Right? This comes to 2 lakh divided by 5. 40,000 rupees. Right? That means you will record a loss of 40,000 in your books related to employee stock option plan. Clear? This much is clear. Now, coming to the journal entries. What will be the journal entry for the record of loss? Number 1 will be for recording loss or expense. Right? For recording loss or expense, we say employees compensation expense account debit, that is, it is for the employees benefit. We say employees compensation expense account debit to share options outstanding, because the options are not going to be exercised at this point when we are recording the loss. Options can be exercised only after a period of 5 years, that is the vesting period. Right? Now this is year 1. 40,000 is to be recorded in year 1. Then year 2, same entry, 40,000. Then year 3, same entry, 40,000. Then year 4, same entry, 40,000. Right? What is the vesting period? It is a period of 5 years after which the option can be exercised. Then year 5, same entry, 40,000. So you have written off 2 lakh rupees over a period of 5 years. You have divided the expense into 5 years because the vesting period is 5 years. Right? Now, after this 5 years, at the end of 5 years, the option becomes available to the, after this, the option is available to employees. Option is available to employees now. In this we have case 1, when all employees subscribe to shares. Now what will happen? What will be the entry? First, bank account debit to share application account. That is, from 100 employees, you received applications, 100 employees multiplied by 100 shares. And how much money is received on application? 40 rupees, right? This comes to 100 multiplied by 100 multiplied by 40, 4 lakh rupees. Clear? Then what will be the entry when the shares are allotted? This share application will be share application account debit to share capital account, right? This is 4 lakh, but in the share capital, what will you take? This is the question. In the share capital, on 100 shares for 100 employees, you will take only 10 rupees. This is the face value you will take, right? In the share capital, you will take 100 multiplied by 100 shares, 100 employees multiplied by 100 shares into 10 rupees. This is 1 lakh rupees. That means here you have to take the face value. Then what will be the balancing amount then? That is the securities premium. Because our share is selling at a premium in the market. The face value of the share is 10. In the market, it is selling at a premium of 50 rupees because it is selling at 60. Now, to the employees, we are giving it at a premium of 30 rupees. So if you are giving it at a premium of 30 rupees, 100 employees multiplied by 100 shares multiplied by 30. This is 3 lakh rupees, or you can say this is the balancing figure. Clear? Right, friends? Now, you have to pass one more entry. This is the expense that you have recorded. Then you recorded here the share options outstanding. Now the option have been exercised. After year 5, you have to close this share option outstanding account because now the options have been exercised. Now how will you close this account? Whatever you have credited to this account, you have credited 2 lakh rupees to this account, right? You will debit this account. Shares option outstanding account debit to which account will be credited? It will be the securities premium reserve account. Why? Because it is a kind of premium only on the shares that were outstanding. So it will be credited to securities premium reserve account. Clear? Whatever share options outstanding you have credited in the earlier years as an expense, now the options have been exercised. So this share option outstanding account will be closed by debiting and credit will be given to securities premium reserve account. Clear? So this is how you pass the entry for ESOP in case all the employees subscribe to shares. Clear? Is this much clear, friends? Now, the second part is out of 100 employees, 90 employees exercised their option and rest of options, that is for 10 employees, rest of options elapsed. Clear? So this is the second case when all the employees are not subscribing to the option. Out of 100 employees, only 90 employees exercised their option and rest of the options elapsed. 10 employees did not opt for the option and their options elapsed. Now, how to pass journal entry for this? The first entry will be bank account debit to share application account, isn't it? To share application account. Now this time it will be 90 employees multiplied by 100 shares multiplied by 40, right? This comes to 3,60,000. Clear? Because we have received applications only from 90 employees who want to exercise their option and 10 employees who do not want to exercise their option, their options elapsed. Right? Now at the time of allotment, this share application will be transferred to share capital. Share application account debit 3,60,000 to share capital. How much amount will be transferred to share capital? How much amount will be transferred to share capital? It will be the face value on 100 shares for 90 multiplied by 10, right? 100 multiplied by 90 multiplied by 10, that is the face value. 90,000 is the share capital. And what will be taken to securities premium reserve? This will be 90 employees multiplied by 100 shares multiplied by 30 rupees as securities premium. So this comes to 2,70,000. Clear? So all the calculation will be done for 90 employees. Here also I will take 90 employees into 100 shares, right? So 90 employees into 100 shares multiplied by 10 rupees, that is the face value, will be transferred to share capital. 90 employees multiplied by 100 shares multiplied by 30 rupees security premium, that will be transferred to securities premium reserve account. Clear? Now we have to close this share option outstanding account. Yes. How to close this in this case when 90 employees have exercised? Let us see. First you will pass an entry of share options outstanding account debit to securities premium reserve account. Now how many shares exercised this option? How many people? 90 for 100 shares. Now what is this share option outstanding account credited with? Market value minus the option value, 20 rupees. So this comes to, multiplied by 20, this comes to 1,80,000. But your outstanding shares account was credited with 2 lakh rupees. Remember? Your share option outstanding account was credited with 2 lakh rupees, but it has been debited with 1,80,000. So still this share option outstanding account is not closed. Then how to close the share option outstanding account for the options which have elapsed? What will be the journal entry for options not exercised and they elapsed, right? The journal entry will be share options outstanding account debit to this amount will be transferred to general reserve. This will become our reserve now for 10 employees who have not exercised option on 100 shares multiplied by 20 rupees. 20,000. This comes to 20,000. Clear? So this is how you are going to close the share options outstanding account. You cannot keep this outstanding account open. Why? For two reasons. One is the share options have been exercised, or the second thing is the share options outstanding which were not exercised have elapsed. So there is nothing outstanding. How can you keep this outstanding account open? Right? To close this outstanding account for the options which have been exercised, you will transfer the amount to securities premium reserve account. And for the options which have not exercised, and which have elapsed, for that the amount will be transferred to general reserve. Clear? So friends, this is all about employee stock option plan, ESOP, right? That the company gives an option to the employees. That is an option, not compulsion. The company gives an option to the employees to subscribe to its certain number of shares after a certain period of service at a value which is less than the market value. Clear? And we have discussed all the journal entries. Right? There are two cases. In case all the employees subscribe to shares, and case 2 is when all the employees do not subscribe to the shares, only part number of employees subscribe to the option. Right? With this, we wrap up the ESOP and we wrap up share capital. This was the last topic of share capital. Right? I hope you have understood all the topics. If you have any queries, just send me an email, friends, at ksjteaching@gmail.com. Right? So in the next lecture, in this book, this was the biggest chapter. Right? In the next lecture, we are going to start with debentures. Right? So that's all for this lecture, friends. Thank you so much.